Well, good afternoon, SLAE family, and happy Tuesday to you. We are here with a hot topic and a true expert today. I'm very thrilled to have this conversation today because the whole country is abuzz about what is going on with interest rates. And we just had a historic interest rate hike, the largest one in 28 years. And since that's what everybody's talking about, we're going to talk about it today in SLAE. And we couldn't have anybody better because our special guest today is none other than Tammy Saul. And I will tell you, if you haven't had the pleasure of knowing about Tammy, Tammy is not only a beast in the mortgage industry, she's also a lawyer. She's the president of Federal Hill Mortgage, which she founded 17 years ago. And just in 2021 alone, you got to listen to these statistics. She did over 950 loans, I believe. It was over $312 million. So if we're going to talk about interest rates and mortgages, we're talking to Tammy Saul. So Tammy, thank you for being here. Welcome. And we're so excited to have you here today.
Thank you so much, Leanne. And after that introduction, I'd better sound smart here, right?
You are smart. You can't help it. And for all of you who are wondering if she conquers the impossible, she's also a mom of two very cute kids. So she's got all the plates spinning. So, and your kids are adorable.
Yeah, thank you. Two kids in my 40s.
Yes, so. Absolutely. So let's talk about all of it. First of all, this is a monstrous hike. Can you talk about why this is happening? Why is this such a big jump? And give people some context for all of this.
Surely. And so first, I'd like to preface what I'm about to say by telling everyone that I am not an expert on the economy. I'm not an expert on why rates go up or why rates go down, but I am on the receiving end of rates because obviously when rates go up and down, it severely impacts the mortgage industry. For many people in my industry in the last 6 months in a very substantially negative way. For me, in the other direction, just because I see opportunity when the market changes. So I'm not an expert on why rates go up and down, but I can share with you some really basic, obvious things for me, okay?
Great.
So what's happening right now is really simple. Demand exceeds supply. That's really what's going on, is that the demand for services, the demand for borrowing money is greater than the supply. This is really because of two things. First, COVID, the rates were kept down during COVID to stimulate spending. Now that people are out of COVID and they're out and about and they have their jobs back, now they're actually spending more than before. So the government raised rates. This is a very basic way to look at it. They raised rates in order to reduce the demand because they can't increase the supply. They've already printed all the money that they've printed in the last few years. Many people have refinanced. Rates have been low, and whenever rates are artificially kept low for a long period of time, as they were for the last 2.5 years, we've never seen rates as low as we've seen for such a long period of time. Naturally, on the back end, at some point, inflation hits, and the Fed has to increase rates for the economy not to tumble out of control. So that's the first piece of it. The other piece of it is obviously the unfortunate war in Ukraine, which for me hit home because I am 100% Ukrainian, just to share with everyone. So that's hit home very closely. But the war in Ukraine, I mean, Ukraine is one of the biggest exporters of food and wheat. Russia is one of the biggest exporters of oil. And so now with the embargo on oil from Russia, with food, nothing is leaving Ukraine. What that's done is it's resulted in a shortage here, and a shortage in anything causes prices to go up, again, because demand exceeds supply. And that's all that's going on.
That's a powerful explanation. Before we do anything else, you know, we all pray so much for the people who are suffering in Ukraine. It's crazy what's going on over there. And I'm sure that does hit very close to home for you to follow that. I can't imagine.
Yeah, it does. Thank you.
So with all of this going on now, people understand a little bit about why it's happening. How does this impact everything? Because there are people who wanted to refinance. There are people who want to buy a home. What are your words of wisdom for people in those categories?
Well, the first is don't refinance is my first word of wisdom. And I can tell you that there are many mortgage companies, as you can imagine, who survived off of refinancings over the last few years,
yes,
who didn't build their business the right way through relationships with strategically with real estate agents, with financial planners, with past clients, and they were just churning and burning refis. Now those same mortgage companies are desperate. Many of them are laying people off. They're losing money. And the other thing that they're doing is that they are setting up telemarketing centers to mass call everybody, trying to try to convince them to do what's called a cash out refinance. And their whole pitch is, let's cash out refinance you, let's pay off your debt, it's going to save you money. I'm telling you right now that that's not the best option. It's best for them, but it's not best for you. So Leanne, one of the things that we as a company have done is we've recognized that debt is at an all-time high. Interest rates on existing mortgages are at an all-time low because people have already refinanced their mortgages in the last few years. And not only that, but people have more equity in their home than they have ever had before because of what's happening.
Sure.
Home prices have gone up that we'll talk about here in a moment. And so people have this equity. And so, for example, one of the things that I've done is that I have opened a home equity division at my company that basically gives homeowners a way to use the equity in their home to consolidate debt, pay for their kids' education, maybe buy another property, pay things off without refinancing. And that's the key. So that's something that we all have to be aware of. Many people listening to this have been getting these calls from mortgage companies, cash out today, don't cash out today, do not cash out.
Tammy, I want to jump in because,
Yeah.
some of our people who are watching this will be very familiar and some will not. And I want to make sure what you're saying is so important.
Yeah.
Can you take like the, Mortgage for Dummies explanation here and teach people what's the difference between the cash out refi and what you're talking about with home equity lines so that people can understand how it impacts them and why one would be better than the other. I really want people to understand your words here because it's really critical.
Yes, thank you for catching that because I do this every day. I forget.
You're super educated, I know. Oh, by the way, Tammy is in the top 15 in the United States of all loan originators. So this comes at her like this. I'm like, okay, what about for the rest of everybody else out here? If you could take a second and break that down.
Sure. Okay. So let's just say you have a mortgage on your home for $100,000. Okay. Your home is worth $200,000. You'd like to get $50,000 out of your home because you have all that equity. Well, what a cash out refinance is it's basically paying off the existing mortgage with a new mortgage that's larger than the existing mortgage and getting the balance of it minus closing costs, of course, as cash out. Well, the problem with this is that getting a new mortgage to pay off the existing mortgage is a higher rate because when you get a new mortgage, you're getting a new mortgage based on what the rate is now. And most people, if they smartly refinanced last year or the year before, have rates in the high 2s, low 3s. But if they're refinancing now via the cash out refinance mechanism, their interest rate will be 5, maybe 6%.
And it's on the whole amount.
The whole balance, right. Now, what mortgage companies are doing who are desperate is they're calling people that they know have a lot of debt. And they're telling them, look, you have a $50,000 car note, you're paying $800 a month. Yes, you're refinancing from a 3% to a 5.5%, but you're getting rid of the $800 car note. So your total expenses per month are going down. Well, on the surface, that looks good, but in the long term, that isn't, because what they're doing is they're putting that car note on a 30-year fixed mortgage, and they end up paying more interest over those 30 years by doing it that way. So mortgage companies, many of them, no disrespect, but this is what they're doing. They're into sales. They need to sell mortgages. And when times are tough, they come up with these ideas. And many people do give into them, because they don't quite understand that they're paying much more interest over time. Is that
right? That's so clear. Now, what is it that you're suggesting and how is that better for a consumer so everybody gets that?
So that same example, I like to tell stories and examples. So in that same example, what we are doing is we are suggesting to that consumer that instead of losing the 3% rate that they have on that $100,000 mortgage by refinancing it, to leave it alone where it is, as it is, and instead just take out a small $50,000 home equity line of credit, for example, to pay off the vehicle, or I have one person, he has to pay for his daughter's wedding. very expensive $75,000 wedding in his culture, but that's what they do. He's got 5 daughters. He has to treat them all equal.
Oof, 5 of them, holy smokes.
He's got 5 daughters. Yeah, so he needs to, that's what that wedding costs. So that's what the home equity line of credit is. It is a second mortgage. It is a second position lien. So instead of refinancing the existing mortgage into a higher rate to get the money out, leave that mortgage as is, take out the second lien, whether it's a HELOC or a HE loan, to capture the equity in their home to do what they want to do. And then in the future, if rates come back down, then they can consolidate the two together into one mortgage.
So in your example, you're leaving that core $100,000 at a low fixed rate. And then the 50 they're able to do, but also they're not tied into a 30-year payment plan with the 50 because it's an equity line, correct? So if somebody wanted to pay chunks of it off or this or that, they've got all kinds of options with how they unload that when they're ready to.
Exactly.
Excellent. Okay, that's great advice. And I think that most people would fall for the, hey, this would be really great. You can pay off a credit card, you can pay off student loans, you can pay off all of it. But if they did have that distinction, which you made, I think it's very beneficial. So what about buyers? What if somebody wants to buy a home right now? What do you have to say to someone in that position?
Surprisingly, it's still very competitive. What I am seeing right now, so what I saw 4 or 5 months ago, maybe even 6 months ago, were many homes with 10, 15, 20, 25 offers.
Yes.
And now we're still seeing those multiple offer situations, but we're seeing fewer offers. The people that are buying now are the ones that hadn't found something when the rates were low, or they're the people who are panicking because they see that the rates already went up. And they know that they can go up again, which is very possible. So in January, rates were still in the high 2s, low 3s. February, they started increasing. March, April, May is when they really went up. So basically we went from 3% to 5.5. For me, my rates are lower because I'm wholesale, but they're still higher than they were back in January. And they're looking at it and thinking, okay, well, what if rates go up to 7, 8% by the end of the year? Then I'll really be out of the market.
And at least now, since there's, and correct me if I'm wrong, please, it's still competitive out there, but you don't have that insanity of 20 people overbidding on a house every time a house goes on the market. So even if the interest rates are a little bit higher, it's more likely someone can get in with a less obnoxious price. Wouldn't you think? Is that kind of safe to say?
Yes. And also I will tell you that it's area specific and it's property specific.
Really?
It is. I am not a real estate agent, but I do observe many real estate agents' activity as a fly on the wall. And I can tell you that properties in the city and condos have far fewer offers, competition, than properties in the county, single family homes in the county. For example, in my own area, Howard County is fierce. I have a neighbor putting their home on the market soon. I'm guessing she'll probably have 5 or 6 offers, and it'll probably go for well over 900, whereas she paid 600 for it 5 years ago. So second homes, I think the demand for second homes, maybe beach homes, has gone down because interest rates for beach homes and investment properties have gone up more than primary residence interest rates. So it's really area specific, but in most areas, it's still very competitive. Again, why? Because demand exceeds supply.
Interesting. And do you see price range differences too? So if someone, for example, is looking for a house that's, $400,000 or $800,000, is there any distinction between that, or it's all going through the same process?
No, the higher the price, the less competition, because fewer people can afford that. So there's a smallish percentage of people who can afford that. But I mean, I had one, a few weeks ago in Northern Virginia, which is usually very competitive, for 1.1, 1.2 million. And I'm seeing maybe 3 to 4 offers on those a piece each time. But I am seeing more contracts come in. Relative to the number of people I pre-approved, I am seeing more contracts come in now.
Wonderful. Well, one of the things that I've always loved about you, many things I've always loved about you. And for those of you who don't know, even though Tammy has got more credentials than any female you'll find in the industry in the United States, we're also really old friends. So it's extra special to have you here today. But one of the things I've always loved is no matter what goes on, and this is a lesson for anybody who's watching, whether you're interested in mortgage rates or this is not your field or you're not even looking to buy, one of the great things about a strong entrepreneur is that they know how to change and take advantage of industry changes. So no matter what it is that you're doing, whether you're in mortgages, real estate, or you're an electrician, or you're a surgeon, or you're a lawyer, or you're a stay-at-home mom, the world changes a lot with the economy, with pandemics, with everything. And you have managed to stay way on top of your game. You're even higher up ranking nationally than you were before the pandemic. So my question for you is, with everything that's happening, what do you see as opportunity? Where do you see your company going, and where do you see you're able to help people with these changes?
Thank you, first of all. Thank you for that. I am an entrepreneur before anything else, and I think it's just the way that I'm wired.
Yes, you are.
So when market shifts and people panic, I see opportunity.
Yes.
I can tell you that in my industry, just because I interact with many people in my field, 80+% of loan officers have seen probably a 75% decline in their business. Many of them have laid off. I mean, just today I hired a person who told me that the company that laid her off a month ago laid off 90% of its workforce, and they're probably closing their doors. So for me, as a company, the opportunity is, number one, the low level producers in our industry who probably didn't belong here to begin with, who were just in it for the quick refinances, are leaving. So it brings, I think it raises the bar in our business.
Yes.
The second piece of it is that I think what we're going to see is we're going to see many people utilize what I just explained, the home equity line of credit, the home equity loan, not just to pay off debt, but to purchase other investment properties at discount. And that's a huge opportunity, because as interest rates go up, the demand for housing typically goes down, but it goes down more for investment properties than anything else, because investment properties people aren't buying to live in. They're not buying because it's a pretty house. They're buying because the numbers make sense on paper. So as the rates go up, the numbers don't make sense on paper unless you do something like a home equity loan or a home equity line of credit on an existing property and then buy it that way. So that's why I opened that division. I see my business maintaining or increasing, because where other people aren't moving to meet the curve, we're moving to meet the curve.
Yes. And I know your business will increase. And I've watched over the years, I've watched your company grow and grow and grow and grow. And then, you became nationally recognized. And then you were just actually featured in a book too, weren't you? What's the name of that book that you were just in?
The name of the book is called Loan Officer Champions. It was actually published last year, so the numbers in it are a little dated. The author of the book is Carl White, who's my coach. He's the one that I attribute a great deal of my success to. I signed up for his coaching
Wonderful.
3 years ago, and he did a case study on 10 national top producers. You can find it on Amazon. You don't have to pay, by the way, because I'm chapter 1. You can just click on the button and see the preview, and there's my chapter.
Perfect. Look at that.
Yeah.
I know a couple of people would love to read that. So we're going to make sure we do that too. So, and then finally, if anybody wants to talk to you, I know that you have great advice, but also where can you do mortgages? People watch this from all over the country, but what areas can you personally service if they're interested in talking with you and getting your help?
Maryland, Pennsylvania, DC, and Virginia.
Perfect. Great. And if they just have comments or questions, is it okay if they post something below this interview?
Yes,
too,
of course.
today? Okay,
Of course.
wonderful.
Yes.
Well, I'm so thrilled to have you here. Congratulations on your success, on being featured in the book, on being top 15 in the country, but more than anything else, congratulations on being one of those amazing women that can do it all, as you do that with 2 little ones.
Thank you.
God, that's amazing. So if you guys are watching this in the Facebook group, Tammy is actually part of the Facebook group. So you can leave comments and questions. She'll check back into that. And if you are watching this on YouTube, you can leave comments there as well. And make sure you give it a thumbs up and let Tammy know you enjoyed it if you see it on YouTube. So Tammy, thank you so much for the distinctions and your advice, and everybody is going to benefit from that for sure.
Thank you so much.
Okay, we will see you all next week, live Tuesday at 5 p.m. Have a fantastic week. Thanks again, Tammy.
Thank you.